All right, let's talk about Japan's economy and political landscape, a situation far more complex and compelling than a mere glance might suggest. What we're seeing right now in Japan isn't just a blip on the economic radar. It's a critical moment defined by shifting economic data, the looming shadow of global trade tensions, and a volatile domestic political scene. If you're interested in how intertwined global trade, domestic policy, and market sentiment truly are, stick around because we're about to unpack some significant developments. Japan's economy, the world's fourth largest, has recently faced a considerable wobble. Revised government data for the January to March quarter of 2025 indicated that the gross domestic product, or GDP, contracted by an annualized 0.2%. While any contraction is noteworthy, this figure actually represents an improvement from the initial estimate, which had indicated a steeper decline of 0.7%. This marks Japan's first economic contraction in 4 quarters, following a 0.6% rise in the previous October-December quarter, which had seen solid growth largely driven by a technical rebound in net exports. The preliminary Q1 GDP data released last month suggested that this slump was partly a payback for that earlier technical jump in net exports. It also pointed to flat consumption amid high costs of living and uncertainty triggered by protectionist U.S. trade policies. Despite the upward revisions in the latest data, the economy still recorded negative growth, underscoring a persistent lack of momentum in Japan's recovery. Delving into the components of the revised Q1 GDP data, domestic demand was initially forecast to provide a positive 0.7 percentage point contribution to total domestic output, but was later revised down to 0.6 percentage points. This domestic demand was propped up by a 1.2% rise in business investment in equipment and software, although this was also a revision down from an initial 1.4%. Private sector non-residential investment specifically saw a revision down to a 1.1% increase from 1.4, largely due to weak software-related investment. Private sector inventories, however, saw their contribution to GDP growth revised upward from 0.3 to 0.6 percentage points, driven by increased stockpiles of raw materials like crude oil and natural gas. Conversely, external demand, which is calculated as exports minus imports, is believed to have significantly lowered Q1 GDP by 0.8 percentage points, a figure that remained consistent with last month's report. This contrasts sharply with the previous quarter, when external demand had added 0.7 points to growth. This contraction in external demand aligns with market expectations, although it still raises concerns about Japan's export-driven sectors. Looking ahead, forecasts suggest that Japan's economic performance in the April to June quarter could remain subdued, potentially marking a second consecutive contraction. This is primarily due to consumers staying frugal amid falling real wages, continued uncertainty in external demand, and firms remaining cautious about their capital expenditure plans due to the ongoing global trade war. A significant factor casting a long shadow over Japan's economic outlook is the uncertainty surrounding U.S. trade policies, particularly the imposition of tariffs. President Donald Trump's administration has instigated a global trade war, with the scale of announced tariffs being considerably larger than many had anticipated. Japan, in particular, faces a proposed 24% U.S. tariff on its exports, which is scheduled to take effect. This looming barrier is putting pressure on Japanese officials to expedite trade discussions. Japan's chief tariff negotiator, Ryuze Akazawa, has met with U.S. Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick in Washington, strongly urging the U.S. to reconsider its tariff measures. Both sides have agreed to continue vigorous coordination, potentially involving an exchange between their leaders around the upcoming G7 summit in Canada. Bank of Japan Governor Kazuo Ueda has acknowledged that these developments in trade policies will exert downward pressure on Japan's economy through multiple channels. He has described the uncertainties surrounding the impact of tariffs as extremely high. Economists anticipate continued downward pressure on the Japanese economy, especially on exports, and there are concerns that capital investment could weaken as a result of rising uncertainty.
Beyond GDP, producer inflation is another key economic indicator being closely watched. The Bank of Japan is set to release its May Producer Goods Price Index, CGPI. Producer inflation in Japan is expected to moderate further to an 8-month low of 3.5% in May, following 4.0% in April and 3.3% in March, which was the highest since June 2023. This moderation is attributed to weaker global demand and increased crude oil supply from OPEC producers, leading to lower domestic fuel prices, which were further capped by a new government subsidy. However, not all price pressures are easing. On the upside, the year-on-year increase in the domestic component of the CGPI is supported by utilities costs, as the government ended its 3-month electricity and natural gas subsidies in March. Upstream goods inflation has also been pushed up by farm produce prices, with government releases of reserves failing to quell rice shortages that have kept prices high, and egg prices remaining elevated in the aftermath of global bird flu outbreaks. In a new development, the Ministry of Agriculture, Forestry, and Fisheries, under new Minister Shigeru Ishiba, has canceled tenders and is now conducting direct sales of old rice reserves to wholesalers, which has reportedly helped bring down retail rice prices in early June, potentially easing upward pressure on processed food costs in the CGPI and Consumer Price Index, CPI.
The Bank of Japan's monetary policy stance is intricately linked to these economic and inflationary developments. At its latest meeting on April 30th to May 1st, the BOJ's 9-member board unanimously voted to maintain the target for the overnight interest rate at 0.5%. This decision came amidst high uncertainty over global growth and inflation sparked by stiff Trump tariffs. The central bank had previously raised its policy rate by 25 basis points to 0.5% in January, marking its third hike during the current normalization process that began in March 2024. The BOJ appears to be still on course for 2 more 25 basis point rate hikes, which would eventually take the overnight interest rate target to 1%. The bank is gradually lifting rates that had been in a range of 0 and slightly negative until March 2024. Despite the economic uncertainties, BOJ Governor Ueda has stated that the underlying mechanism by which wages and prices rise moderately in interaction remains intact. He emphasized that if Japan's underlying consumer price index inflation approaches the central bank's price stability target of 2%, the BOJ will continue to raise its policy interest rate and adjust the degree of monetary easing in line with improvements in economic activity and prices. Given the extremely high uncertainties over the future course and effects of trade policy, Governor Ueda has pledged that the central bank will carefully examine factors such as developments in economic activity, prices, and financial markets both at home and abroad, making decisions without presuming its outlook will materialize. The central bank has also downgraded its growth projection for Japan, cutting its GDP growth forecast for the 2025 fiscal year to 0.5% from 1.1% projected in January, and the 2026 fiscal year forecast to 0.7% from 1%. Adding another layer of complexity to Japan's current situation is the dynamic political landscape. Prime Minister Shigeru Ishiba and the main opposition Constitutional Democratic Party of Japan's Yoshihiko Noda, along with other leaders, are holding their third round of debate in the Diet. The agenda for this debate includes discussions on high costs of living, the critical Japan-US trade talks, and a possible move by the opposition to submit a no-confidence motion against Ishiba's cabinet. Japanese news media have reported that Prime Minister Ishiba is considering dissolving the House of Representatives, the lower chamber of parliament, and calling snap elections. This potential move could occur if opposition parties challenge his leadership with a no-confidence motion before the current 150-day Diet session concludes on Sunday, June 22nd. Prime Minister Ishiba was re-elected in a rare parliamentary runoff vote on November 11th following the ruling coalition's loss of a majority in the lower house general election approximately 2 weeks prior. Many voters, wary of high costs, punished Ishiba's conservative Liberal Democratic Party for a political funding scandal. In the 465-seat lower chamber, the LDP won only 191 seats, a sharp decline from the 256 seats it held before the September 27th election. Its coalition partner Komito also saw its seats reduced to 24 from 32.
2022. Together, the coalition holds only 215 seats, falling short of a simple majority of 233. In contrast, the opposition Constitutional Democratic Party of Japan, CDPJ, increased its seats significantly by 50 to 148, while the Democratic Party for the People, DPFP, also saw its seats rise to 28 from 7. This shift in power dynamics creates a highly charged political environment, with the possibility of snap elections adding another layer of uncertainty. The interplay of these economic, trade, and political factors is directly influencing the Japanese yen's performance. The yen remains on the back foot against a broadly recovering US dollar, though it has managed to trim some of its intraday losses. The optimism surrounding ongoing US-China trade talks is a key factor undermining the safe haven yen, as positive resolution often reduces demand for traditional safe haven currencies. However, firming expectations that the Bank of Japan will hike interest rates again are holding back aggressive bets against the yen. This contrasts sharply with expectations for the U.S. Federal Reserve, where traders are pricing in the possibility of further borrowing cost reductions. This policy divergence between the hawkish expectations for the BOJ and potential easing by the Fed helps to limit any significant U.S. dollar appreciation, thereby capping losses for the lower-yielding yen. The updated GDP data, combined with resilient consumption and persistent inflation, has intensified speculation about the Bank of Japan's next steps, with market sentiment leaning towards a greater chance of a rate hike towards the end of 2025. This shift in sentiment has provided fresh support for the yen. However, some analysts remain cautious, arguing that the revised figures fall short of indicating a solid economic rebound, especially with the looming trade risks from the U.S. In conclusion, Japan finds itself at a pivotal juncture. The economy is navigating a period of contraction, albeit a less severe one than initially feared, with domestic consumption showing some resilience but external demand remaining a significant drag, largely due to global trade tensions instigated by President Donald Trump's administration. The Bank of Japan is proceeding cautiously with its monetary policy normalization, balancing sticky inflation with economic uncertainties stemming from trade disputes. Simultaneously, the political arena is rife with debates over living costs and trade, with the possibility of snap elections highlighting a government struggling to maintain a parliamentary majority. The Japanese yen's performance will continue to reflect these complex, interconnected dynamics, influenced by both domestic policy decisions and the fluctuating tides of international trade relations. It's a landscape that demands careful observation and a nuanced understanding. Thank you for tuning in.